Good morning, traders. Welcome to what should be a boring day until much later on today. Not expecting much, just the calm before the storm. So hope you all got your umbrellas ready. Morning, Kay. Got your galoshes on?
Morning, Ryan. For the time being, I've got my eye flaps on, and I'm trying to relax a bit before it all boots off later today.
Yep. We get these little calm periods, so don't do anything stupid. Have a little break, have a little breather, give yourself a bit of a morning off, and get prepared for what's to come later. Right, that's what we're going to be doing. First, we'll get over what has been before we get into what is coming. We've had a bit of data out this morning, starting off in Japan, trade balance data for August. Still a deficit there, but not as much as expected, 242.5 billion yen deficit. As you can see there, imports down a chunk again, 5.2%. Some big numbers coming in now. Exports, though, still negative, but not as much. We're expected to fall 1.9%, still come in negative, though, minus 0.1%. Activity-wise, you don't want to see negative numbers in the imports and exports, even if you have a deficit, which is still not good news. You'd rather have that with activity than a lack of activity. But again, we're still probably trading out all this trade and tariff stuff and what's going on. So probably can't get a clear picture on that just yet. Anything you're taking from those numbers, Kay?
Not really, mate. It's probably going to go up and down. Quite a bit. Because as we know, I mean, Japanese always they have been kept in not in the dark, but and nothing was really clear for a long while. So I guess those numbers will be important going forward. But I don't see too much of alternative to what Japan is doing on trade right now. They are going to need the US, but then this trade number will probably those trade numbers trade balances will probably be impacted with all those promises they made to the US of buying much more stuff from them. So they may actually be in a negative trade balance for a while. But what is that? That's expressed in yen, is it?
Yeah,
So I mean, it's a tiny amount.
yeah, exactly. And it's a bit of a weird situation as well because they do have such heavy influence. A lot of companies they produce in other countries.
Yeah.
They really are a multinational country. So it's this is just domestic stuff really. It doesn't sort of show the full picture, shall we say, and what they do abroad and whatever. But anyway, let's move on. We've got far more important things to talk about than Japan's trade balance right now. Something else on the line was UK CPI this morning, and a little bit on the soft-ish side, particularly that core CPI number coming down 2 pips to 3.6 from 3.8, and it was only expected to fall a pip. Headline CPI, though, stays unchanged at 3.8. We've had the retail price numbers as well. They came in softer. RPI coming in at 4.6 from 4.8 previously, and the core RPI also dropping 4.4 from 4.7. Overall, yes, it's a little bit softer on the inflation numbers, but we're still running high. No real change for the Bank of England upcoming this Thursday. Those numbers shouldn't shake the tree. Go in the right way, but not going fast enough yet to get the Bank of England worried. Moving on to the UK. Well, moving on, I say, from that data, staying in the UK, we've got Mr. Trump coming over today. He's kindly scheduled a news conference with Fox News, bang in the middle of POW. So we're going to, have to watch two things. Well, you don't have to, but it might be worth doing that, because if he wants to lay into Powell while he's still talking, that's going to be fun and games. Anyway, he's over. Mentioned yesterday that Starmer had been thrown a bit of a bone in being able to announce some trade deals and agreements, and apparently Microsoft and OpenAI are looking to invest around $42 billion in the UK. Also, Nvidia is apparently going to build an AI infrastructure and ecosystem to drive innovation, growth, and jobs, getting all the lines out for the population. That's what you'll hear the government spout enough about. Going the other way, GlaxoSmithKline is going to invest $30 billion in US R&D and manufacturing over the next 5 years. So there's money going the other way. So all friendly, all tickety-boo in terms of potential investments both ways, which obviously Starmer will claim the win for, even though some of this stuff was agreed. Like I think the Microsoft thing, part of that was agreed back in 2023. So he'll still claim the win. Anyway, it's good news. Not that the pound has responded too much, and it's going to be all over the future. And anyone who wants to build anything still has to go through a 18 billion page environmental impact assessment before they can lay a brick. So we'll see when that stuff comes through. Over in Germany, the Engineering Association VDMA, they see production in 2026 growing by 1%. These guys have done nothing but cut their projection forecasts for the last, I think, about 2 years. They now expect 2025 production in Germany to decline by 5% versus declining by 2% previously. So it's going to be a dour end to the year by the looks of things. ECB's Simkus says the easing cycle was nearing the end, but it might not yet be over. And he also dropped this gem. Santa Claus may come. He may trim the Christmas tree, but not significantly. Too early to be speaking about Christmas. Not even done Halloween yet. ECB's De Guindos says the current rate is appropriate. Kay, just going back to the UK stuff, you know, we heard big investments from Germany. Okay, we're talking 500 billion versus 40 billion. But the Quid not really paying attention today to that sort of stuff.
Giving back just a, well, no, taking back, if you look at the cross site, taking back just a little bit of what it lost yesterday, especially on the euro sterling. But yeah, I mean, it's all those small victory and victory laps. Yesterday, Trump was very friendly to Starmer, so a bit of an up and down, but it's probably going to move more on the combination of the Fed and tomorrow's Bank of England than those two lining each other's pockets.
Yeah, and all that stuff is going to continue today with Trump over here. So we'll see what that may bring. Right, moving over to some of the US stuff from yesterday. We've got retail sales. I've even got my calendar set up. No, I've had long enough today to do that. Retail sales data coming in above expectations. You can't bet against the consumer. We're still in the summer months over there regarding this data. Headline sales coming in up 0.6% versus 0.2% expected, and a rise up last month. The control group, retail control group, we saw like the core sales, although this calendar has two sets of core sales, also coming in up 0.7%. So that was better as well. Price pressures, import-export prices still in the positive, were expected to dip on the month, but instead they went up both 0.3%, though the year-on-year for import prices coming in flat. Export prices, though, up 3.4%. So good numbers ahead of the Fed. The consumer is one less thing for the Fed to worry about, but it also shows that the economy as a whole is still trucking along. Yes, we've seen weaker jobs data. yes, it may lead to something more, but so far things are still going okay. So the Fed at least will be looking at that and thinking, well, the consumer's doing all right. We don't have to worry too much there. But their focus is the jobs data. And if we start seeing wholesale job cuts, then that's going to obviously impact the consumer down the line. So that's what they will try and get in front of today. Over in Canada, CPI there, a little lower than expected. Headline coming in at 1.9, was expected at 2%, but other sources had it at 1.9 as well. Their core measures, the common coming in as expected, down a pip to 2.5. The Bank of Canada's core number unchanged, 2.6. As I mentioned prior to that, that's the fourth month it's been sitting there, and all the other numbers coming in round as expected and prior. So not much there for the Bank of Canada, except that inflation has ticked up, and other measures are looking a little bit sticky. They are expected to cut today as well. But I think, Kay, they'll probably, same boat as the Fed, they'll be looking more at their jobs market over inflation.
Jobs and growth, because they've been saying that they were quite affected by Q2 especially. So it will be interesting to know what they will say about Q3, about the growth and the negative impact of tariffs on their growth. So they will probably indeed look at jobs and growth over inflation. So yeah, it should be an interesting meeting, especially as well that the Canadian dollar has been a bit moving moving up and down of late. So yeah, it's going to be interesting, I think, this afternoon.
Yeah, thanks, mate. I just want to jump back to Mark's comment. He says, this is the best show in Europe. I'm disappointed by that, Mark. We want global domination. Europe's okay. We want global domination. But no, thank you very much for that compliment. Much appreciated. Right, back to the data. We had some bits and bobs drop in later on. Industrial production, manufacturing, all coming in positive, although we're still talking 0. This is a 0. That is. But positives are better than negatives. Capacity utilization coming in unchanged, although the prior month was revised down, I think, from 77.5 to 77.4. But again, things are still ticking along. The NAHB Housing Market Index was expected up a bit, came in unchanged in the end. That one has been running a little bit soft-ish. It's not really trending anywhere, but we've seen better numbers from there. We also got some inventory data as well. Business inventories, for a change, coming in at 0.2%. I think these bloody things have been 0.2% for about a year. Let me check. I know it's been a while. Oh, the last two prints. There we go. And then it was 0.2 before. Anyway, not important for today. Right. We had a 20-year auction, which was pretty decent. Again, the numbers bit to cover. Indirects pretty good as well. Yet more, it seems like, bond traders or investors looking to lock in some of those higher yields ahead of potentially the Fed embarking on a little cut cycle again. So locking it in there. Did you pick anything out of that auction particularly, Kay?
No, although the only thing is the interest of it was that it saw quite a bit of interest, which in theory, looking at how everybody's now more doing the short end, yeah, could mean that that some people realize that yields may not stay high forever.
Yeah, exactly. And that's a good thing. We'll have to see what happens after we've got through the Fed and everyone knows what's happening with them guys. Then we might see a different picture in auctions, but that's down the road. Treasury Secretary Besant was talking on his meeting with Bullard, who's up for the Fed job. Says he had a good session with Bully Bullard and that he knows the Fed well. Then he went on to say, if Trump thought inflation was a problem, he'd be willing to have rate hikes. And then talking about the Fed, we will see if the Fed is neutral or accommodative. Expects we'll see inflation starting to come down. Then he had a little waffle on their meetings with China over trade. Says we need to meet again before the 10th of November, and talks have become more productive. The Chinese sense a deal is possible. I guess we'll hear from those guys whether that's the case or not. As mentioned, Trump in the UK, he says he will look to refine the trade deal with the UK a little bit, and that the UK would like to refine the trade deal. So that might be some further headlines we get today, if there's any tinkering around the edges of that trade deal. Reports yesterday, apparently from the US Trade Department, said they're going to start a public consultation of the USMCA renewal today. They said yesterday it'll be tomorrow, which is now today. We knew that September, October was the window for when they might start ramping up talk on the USMCA. So that's probably going to bring the Canadian dollar and Mexican peso more onto the front pages, depending on how that goes. This, whatever they do in this public consultation, I'm not sure. Asking firms and businesses and whatnot, I should imagine. But it's the next stage after that into what they're going to look to renegotiate. So again, this is something post-Fed that we're going to step over the line into, where it's going to be more about those currencies to come. Kay, how long do you think that saga is going to drag out?
Good question.
I know it's a bit of a how long's a piece of string question, but
yeah, exactly.
Anyway.
Could last forever. It won't be done. It won't be done in the next 2 weeks. That's for sure. But what is going to be the renegotiation of USMCA? Is it going to be including current tariffs, or are they going to go for a complete overhaul of everything? In which case, both Mexican peso and Canadian dollar will be at risk, obviously, during this whole period, depending on how harsh the US wants to do in the renegotiation of everything. Looking at the relations that we have now, I still would think that on USMCA terms alone, not talking about migration, etc., but on USMCA terms alone, I still would favor potentially Mexico over Canada a little bit. That would still be my bias when it all comes out of it. Obviously, the three parties will have to sign it. So if the Canadians think that they are being done wrongly, they will probably they will, of course, they will negotiate and not be happy about it. So there's going to be a lot of back and forth there, I think, especially knowing Trump and his close administration. It's probably not going to be an overly pretty thing at first. So there's going to be a lot of back and forth there, I think, before we get to see the complete new USMCA.
Yeah, I think so too. I think anything. Oh, excuse me, I need a quick sneeze. I think what we could get early, as you say, is what Trump's unhappy about. He's going to be quick to go, right, well, this UMCA, I don't like this, or you guys haven't done that, and he'll just like he did with the prior tariff stuff. He said what he's not happy with and what he's going to hit. I think that's going to be the same again. So that's probably where we'll get the biggest initial moves once he threatens what he wants to change, and then obviously we go into the negotiating phase like we did before. So we've got the potential to maybe see a big price reaction like we did with the tariff deadlines, and then that reaction becomes less and less as they start getting into the super nuts of it. So watch out for that initial reaction if we get one, because that may be the biggest one we get in prices. Apparently, we're going to get a House vote on a 7-week government funding bill on Friday. We're still in this situation where the government could shut down at the end of September. But it looks like we're getting another can kick, which just based on my sums will put us at the end of October, roughly beginning of November, which means we'll need another can kick by the end of the year, which will probably punt into February. So that's all going ahead. Okay, anything else, mate?
Nothing that is going to derail a good FOMC tonight.
No. Oh, one thing I forgot to mention, that FT piece on Reeves at the UK. Apparently, the OBR is set to downgrade their forecasts for the headroom or for their productivity. I can't remember what it is they're cutting, but they're cutting that, and it's going to increase the fiscal hole that Rachel Reeves is going to be heading into, which likely means higher taxes, more tax rises at the budget. That's not good news, but that's something for November that we'll have to deal with once we get over the all this stuff today. So just keep an eye on that news. That's it. Right. Okay. I'm going to put you on the spot right from the off. Okay. What are you doing over the Fed?
Well, first of all, I've been reducing my dollar shorts over the past, let's say, 20 hours or so. Been reducing the shorts. I've actually only kept a couple of currencies on where I'm relatively deep in the money, and also with greatly reduced risk. I even managed to reduce my very long-term silver exposure as well, about a buck higher than where we are now. So yes, I'm going really with an open look into this FOMC, because there are a few possibilities here, right? So we could get from, let's say, the dovishest until the most undovish possibilities. We can go from a 50 bps cut panic over the jobs market, over a 50 bps cut, but signaling or not opening any doors for the rest of the year. Then we can go to a 25 bps, opening the door for the rest of the two meetings of the year, because can't cut 50 now because inflation, etc., etc. We can go to a 25 BP now, and then saying like, well, completely data dependent as they have been for a very long time, and then the market won't know what to think about it. Is probably going to go in lengths over what the balance is between, well, hopefully, what the balance is in their opinion between the jobs and the inflation. And then we can actually go into, well, I mean, 25 is baked in, right? I don't think they will, there is any possibility that they hold their hand still. And then we can, yeah, go 25 and actually remain pretty hawkish, saying that those jobs market revisions are due to migrants, due to people uncertain, whatever, and then but it should be temporary, and he's placing jobs and inflation back on the same footing, which would be the hawkish cut, right? So, and we can't exclude really any of the possibilities, although the extremes are likely having the least probability in percentage wise. But what I think really is that they do 25 and they leave the door open for the other two meetings, because the warning signals on the job market have been hot enough and red enough to not let it go. Let's not forget as well that they are, or at least Powell said that he thought that the inflation spike or inflation higher. He didn't say spike. He said it could last for a bit longer, but it should be temporary. We're back with the temporary over the tariff thing. So I suspect And that's where I'm going to place the highest probability that they do 25 and they leave the door open for the last two meetings.
Yeah, I'm pretty much in line with that. I'm going to try and keep it simple. I'm more interested about what they're signaling 2026 than what happens today. outside, excuse me, outside of whether they put a 50 or whatever. I don't even really care what they're going to do the rest of this year, unless it's a bit of a shocker. But yeah, where my marker is going to be where they think rates are going to go next year, because I think the market is well placed around the 3% mark. And if the Fed are more dovish or less dovish than that, that's going to bring the next reaction in the market. We are in a position, given what we saw yesterday in the dollar getting sold off, we are now in a position, I think, where there is a stronger risk that we have a sell rumor buy fact situation as far as the dollar is concerned. So if the market gets exactly what it wants, then it's already priced, and you're probably going to see a bit of profit taking, maybe a bit of reversal. But we're not going to know that until the lines have dropped, power spoken, and then the market's going to take stock of everything afterwards. What I want to, yeah, go on, mate.
Yeah, I would though say, because you're saying what they're interested in 2026, I think it's very important what they do for the rest of the year, because we have seen, because what is happening in the market, and those let's say reluctance to buy into whatever Trump is doing as well. We will see, normally we should see in the dots whether I don't think they will change at 3% on the long term, but it's the path of getting there, and that's going to be important still for 2025. It's the path of getting there. If that's an accelerated path, I still think the market will react to it. And what happens in 2026? That this market we have seen so often suffering from global Alzheimer. I'm not even sure that this market is already going to look forward to what's going to happen in 2026. That's just a difference of opinion, but I don't think that we will be able to trade today what's going to happen in 2026, in short.
Okay, yeah, I'm going to obviously disagree with that, because the market's always looking 3-6 months ahead. The difference about this year is whether we've only got 3 meetings, so it's whether they're going to cut 3 times or 2 times, and that margin I don't think is enough for the market to throw a paddy over whether it's getting 2 or 3. Because if it thinks it's getting 2 this year, it's going to expect 3 next year. If it gets 3 this year, it might expect 2 next year. If it's got 3% circled on its calendar for next year. So I don't think that's a big enough margin. If we were talking 100 basis points of cuts for the rest of the year, that's a different kettle of fish. That's a more dovish outcome. But whether it's 2 or 3, I don't know if the market's going to get overly anxious about that. But we shall see what we shall see. And I want to make the more important point here that both Cayman and the positions both Cayman and I are in. I don't know about you, Kate. I'm Zen-like today. We had our plans coming into the Fed. We know that you're trading. The Fed is all about trading before the Fed. We were short in the dollars. You've closed up a lot. I've closed up a lot. I've closed on my dollar yen shorts. I've closed a bulk of my dollar mex shorts. I've taken some of my longer bits off at my longer term dollar mex off. I've closed up some cable. I've done my Fed trading effectively, and we're not even at the meeting yet. So both of us are going into this meeting, not sitting here thinking, I have to make money out of this today. We can sit back. Yeah, we can snipe if we want, and if we hear a headline or whatever, but we can sit back and watch it in peace and serenity and plan what comes after. And I think, Kay, that's probably the biggest lesson we can try and teach traders now is learn how to manage these events. You could get lucky and make 100 pips on this, okay? But most people are going to be taking a punt. Oh, I think the Fed's going to do this. I think the Fed's going to do that. yeah, you could make a good amount today, but it's not about today. It's about where the next 500 pips are coming from, not what you might grab today. Yeah, I assume, as I say, you're in a bit of Zen mood today as well. In
Totally
terms of
relaxed,
trading.
mate. Totally relaxed. I mean, a bit of crosses, but we will see about the euro sterling tomorrow. No, I mean, a bit of crosses, and yeah, on the dollar side, I'm nowhere near any risk profile that I may have had over the past week or 2 weeks or 3 weeks, and no, I'm actually, it's going to be easier as well to react to stuff, whether the market is overreacting on the one way or on the one side, or whether we need to re-enter. We will see after the meeting, and yeah, that's the thing. If you make money ahead of it, let the pressure go, and you don't need to feel any pressure. As Gavin said, better to be nothing rather than being in deep shit. Yeah, that's also true. And the thing is as well, if and the opposite is maybe even more important. If you have not been having a really good time now, please do not try to make back anything ahead of that Fed meeting, because it could only make things worse. And then if you look at a bigger whole, then your pressure will be even bigger on the Fed meeting. The pressure that you put onto yourself, that is paramount, that you don't let that pressure overtake what the how shall I say, the healthy position taking and the very good risk taking is going to or should dictate what you are doing. Okay, so if you had a bad run, I mean, reduce everything this in the same way. Reduce everything and look at what the opportunities, not the risks. The opportunities will be after the FOMC. So, I mean, yeah, I mean, whether you're in a good or a bad position, this is not the time to start to go all gung ho on everything, trying to make back, because usually, maybe not today, but usually it's going to cost you money, more money.
Yeah, and you can have plenty of time to assess what happens, and then refine your strategies and look at what the trades are moving forward. But I know a lot of traders, particularly part-time traders, they're thinking, oh, I'm going to finish work early, I'm going to plonk myself down in front of the Fed, and I'm going to trade it. Probably the worst thing you can do, the absolute worst thing you can do in that situation, because you've grabbed that time and you're feeling pressured that you got to trade it. Yeah, you might be right, but it's more a gamble, it's more a coin toss doing this than waiting and thinking, right, how's the market going to move over the next few weeks ahead, and let me position for that. Give yourself some time. Your job is to reduce pressure on yourself, not increase it. So yeah, you need to look at that. And Galaxy, you're right. The year will depend on employment reports if they continue to soften. Yeah, it's exactly right. What I've been saying for the last few weeks is that this period is a big one. This is probably the biggest Fed meeting. I would say the biggest Fed meeting this year. Okay, we've had to wait to September to get it. Because the market is going to make a big adjustment. It has made a big adjustment. Okay, from that point, it's going to say, right, this is where we're at. What is going to change that? And then we're back to watching the data. Okay, and if next month's NFP shows a minus 200k and 4.7% unemployment rate, yes, the market is going to get bearish. Expectations for further cuts are going to creep in, and the dots that came out today are going to be redundant because the market's going to get even more dovish about it. And that's what will trade going forward. Okay, trade around the data. If the data doesn't change, if the data holds up, then we might get some minor changes to expectations, but it's going to be a much tighter or much less volatile trading around that data than it has been coming into this number, because we've had that kick in the teeth. Before August, before Jackson Hole, we were all talking about how the Fed can cut once because of what the data was showing us. Jobs market was holding up, the economy was doing well. There was no wobbles. 2 months later, now we're wondering if they're going to cut 50 basis points. That's how quickly a market can change. And it could change the other way as well. we get a 200k plus jobs report and 4% unemployment rate, everyone's going, well, 3 cuts next year or whatever is too much. And then we get an adjustment the other way. So, yeah. But then the Fed don't get to change their opinion and their forecast until December. So we play this game all over again. So that's where we're at. So anyway, we're all done as far as the Fed is concerned and what we're expecting for that. What about the Bank of Canada, Kay? Any fireworks on them? Is there any risk at all that they stay unchanged?
No, I don't think so. They on the latest data, they should be cutting, right? That's what I think anyway. But they are getting, they're what's his name? Stiffers. He's already said that they already came a long way. So we may get a hint of a 25 and then him saying, oh, now we are where we wanted to be. So that is the only positive Canada risk perhaps that there is in there. But
yeah, because they are in the middle of their neutral range.
Yeah, they are. And if they cut down to 2.5, we are not very far from where they may be wanting to land. So he could go say, especially if Rogers is poking in his back, he could go and say we're done for now, which is then perhaps going to cause a little wobble on the top side in the Canadian dollar. But I do still think that if you look at the overall, yes, dollar Canada has been coming down, but then all the dollars have been coming down, right? But if you look at the Canadian on the crosser side, it's still trading very much on the defensive end. Well, you know what? I mean, if he comes out like this, if we see a bit of a rally in the Canadian dollar, I may actually do something, but rather in a cross than doing in dollar Canada ahead of the FOMC.
Yeah, I don't know. Is it a forecast meeting today as well from those guys? Or was that last
There
month?
is a press conference, September. Yeah, should be. Yeah,
Or was it August? I can't remember.
should be. I'm not on the Bank of Canada page.
No,
I
I
may.
am, but I can't find it, so I'll have to look
Oh,
later.
okay. All right.
But yeah, so we get a presser anyway, but I'm not sure if it's a forecast one or not. I don't think it is, but I could be wrong. But yeah, but they're in a different situation to the Fed. You know, their rates are 200 basis points lower than the Fed at the moment, give or take at the moment. So you know, they haven't got a lot of room to move from neutral into accommodative, shall we say, and that may hold them up. So yeah, it's going to be an interesting one. This one later on. Right, I'm only going to look at a couple of things because I'm just going to sit back and I'm not really interested in much until I know what's going on. Dollar yen, we're knocking around this support down here, having another go. It's been a big level down here, 25s, 20s, 30s, a bit of a gateway if we break below it. Like all these big events, I don't give a stuff about technical levels, coloured lines, 50, 100 pips away from or within 50 and 100 pips of where the price is now. We could be down at 145, we could be up at 148, 149 by the end of this. So all this stuff in here, I don't care about until I know all the details, and then any levels that are broken, I'm going to bring them back to it as importance to see if they hold on retests or something. So if we busted up above 147 and suddenly we, you know, drop again, do we hold 147? You know, that sort of move would say, right, we've had all this noise, we're over the shock of it. Now are the levels going to come back into play? And then you go back to, you know, deciphering what levels are going to be important again. But I don't care about anything 50 to 100 pips from here. So I'll set my stall wide. I'm not usually I'd look for a counter trade here and there, a stretch point. That is fine over a normal meeting where you may get a bit of a change in language or something. But this has the potential to set the dollar yen one way or another, or set the dollar one way or another for maybe a trend move. So that's what I'm going to be looking at. And for this pair, after we're all done with the Fed, we're going to be moving on to yen things and that leadership election. So we're probably going to see a bit of a focus switch in terms of this one. So if the Fed's dovish and we see a move to 145, a couple of days later, we could be getting headlines about leadership contest and we're going all the way up again. In that sort of situation, Kay, what would you do? Would you counter trade the election stuff, knowing that the dollar, let's say, is still in a bearish phase amongst its peers?
I rather look to trade crosses. But the interesting thing is that I've read a couple of analysts. Okay, they can change their view overnight, of course. But read a few analysts, and there's not a lot of them saying that the yen would weaken on the LDP election. So, and I find it a bit surprising because I think if Takahashi gets it, it's really going to be Abe version 2, and the yen is going to get a real slap around the ears. But the most that people that I read is that it seems that they think the elections, LDP elections, stability, etc., could actually be positive yen. But okay, I'm going to leave that in the middle right now. I'm still thinking that if we don't get a dovish, or if we would get, like, let's say, a surprisingly undovish FOMC, that yen is one of those candidates to go on a flyer. That could trade back to 148 in a flash. That's still where I'm at with all things yen right now. Bank of Japan is probably not going to move. It would have been different if there wouldn't have been all this LDP election stuff. I would have said that there was a bigger chance than what the market was pricing in that the Bank of Japan would actually move this month. But yeah, with those elections, it's probably not going to be wise to expect them to move. So yes, then we are going to be trading back election things. But then it will depend absolutely on what the dollar is doing, because there's always going to be a dollar impact in whatever happens in yen. It's not only the crosses driving, but so far, of what we have seen over the past months, so far the dollar yen has been held up by those crosses. So I'm for sure not going to dismiss any of the yen crosses.
Yep, exactly.
By the way,
yeah.
it is just an interest rate announcement on the Bank of Canada.
Cool.
The other meetings, it says like interest rate announcement and monetary policy report. Now, for today, they don't talk about monetary policy report. But since there is a press conference afterwards, what does it really change?
Yeah, no, exactly. I did think it was last month the thing. I think they're in line with the Bank of England when they do that. But anyway, not it matters. So yeah, press conference. It is. That's all we're getting. Right. The only other chart I want you guys and girls to concentrate on today is 10-year yields, because it is a good guide. You don't have to trade it. You don't have to understand it. You just have to know it's a good guide for judging how the dollar is moving. Okay, it's pretty rigid at times. If yields stop at certain yield levels, that can put the brakes on any dollar move. It's been very, very nicely playing. When we've hit these 450s, when we hit the 420s, when we broke the 420s, when we hit the 4%. So watch your numbers here, because if you get a big move in the dollar and a big move in yields, if it hits one of these solid areas, as I say, that can put the brakes on any dollar move. It doesn't mean you're going to see a massive reversal. It doesn't mean pile in and counter trade it. What it means is the market has made its adjustment. It's made its initial move. And this is where the price is taking a pause. This is where it's stopping, whichever side it goes. Because the market does three things. It has the initial reaction, all the volatility we're going to get tonight. It then has its couple of sessions just to take stock of everything and, think about what it actually means for the longer term. And then after that point, it has its potential trend move where it says, right, yeah, we know what's going on, but we need to position ourselves this way, that way, the other way. And that's when you see a more drawn out move. So you could hit 420% on a hawkish Fed and the market goes, right, reprice, what's going to happen? Does it mean we're going to be going? And if they're really hawkish, then you'll probably start creeping through 420, and the dollar will creep on again over the days ahead. Or it hits the wall, and the market says that's it, and then we go back into a range. So that's why you should have these 10-year yields open over the Fed, just if you're trading the dollar, to see what it might do and how far it might go. Right, mate, over to you for a couple. I feel all analysed out. I don't know what to do now. I'm just going to sit and watch.
Just take it easy. Go for a cuppa and come back at what is it? 6:30, 7:30? Oh,
Yeah.
it's going to be late again. I hate it. We're joking about the continents moving back together, but in a million years we will be back in the same time zone. That's going to make it so much easier for us to do our show.
Yeah, we still have GMT and BST.
Oh, really? Yeah, but
Cool.
the B not standing for British, but for beer.
Yeah,
Um,
yeah,
yeah. Just one thing before I look at the currencies. I did look at your Euro Swiss yesterday, Ali. I just told you that for as long as we are in the ranges, I'm not even going to look at it. So well done on your short. There's still people thinking, and I actually said that yesterday, that some people thinking that the Swiss franc is still a light currency because of the stability of things, although the fundamentals are not really supportive for the Swiss franc. But I did comment on your Swiss franc, so you may have missed that little part of the conversation. Euro dollar, we moved above the 118.30 and we are moving back to it. On the wider picture, first of all, it is, if we get really a dovish FOMC, this level here is going to be your next important level. Why? Because it is the 78.6% of this whole move down from even 2018, even from the highest, 125.5, and the first leg, then another leg, and then going to the lows. It is the 78.6% of that move, and it's your last double top before we went down quite massively in back in 2021, where the dollar started to really turn. So 119.15 is the next important level here, and then we will be talking about 120, obviously, the market. And the funny thing is that we have a trend line here coming from that 2018 high over the 2021 high, and it's coming in like nearly on the dot, 120. Okay, so psychological level, whatever, it's going to be a very, very important one if Powell and friends are giving us the dovish report that somewhere the market is hoping for, at least the longer term, as they will be hoping for this confirmation that they are right and continue to push the boat on their dollar shorts. And also what is important, and I'll have probably well, I'm looking at the clock, maybe not. But what's important, and I'm just going to say it, is that since yesterday, and actually it started embryonically the day before already, we have seen actually a good few euro crosses doing better as well. So this brings the euro dollar back into the league of the pairs that since the euro crosses are supported, if the Fed is dovish enough, it is one of those candidates that could go the fastest. Okay, so we always look at stuff that can go the fastest, the slowest, which one is reacting, which one is not reacting to certain events. All right, if they are not as dovish as the market is expecting, but somewhere in the middle of the road, we could easily get back to that 117.80 here. That would be the first level to watch. And then if they are really not giving the market what it wants to see immediately, it's probably going to get through it, and then we have a move back into rather. Yeah, which is now not too far away from the middle of that range that we have seen, around 117.40. The big level, I think, is still lying now around 116.65. But will any of this meeting, I mean, that would really, really, really be the surprise, I think, if we get down there. I think if he only gives the market half of what it wants, we can see a reaction because of the build-up. Okay, but I would suspect somewhere around here. We need to really monitor closely around that 117, call it 35.45. If we ever get there, it's also kind of even a bit stretched the extreme of what the options are expecting overnight zone. So I'd expect that somewhere around here we would be finding support, unless the Fed goes, yeah, we do one cut and then see you next year, but they won't do that. And then I've already spoken about the top side. I'm not going to talk about the yen. Ryan did that. Cable, interesting. Yesterday, and I told you already, and on my updates every day, I said, like, okay, if we have to get through 135.90.95 to have a look at 136.50.70, and that's exactly what happened. And we also stopped there. So that is also interesting. So 136.70.75 is your gateway to, if it would be a dovish report, to up to this 137.5, 138, and then we will see what happens, because we also know, as we've been already saying about the sterling and everything that goes on, perhaps the sterling there would be kind of enough for this move, I would say. What happens if we get a bit of a move lower? Well, watch the break, 135.90.95, easy. And then below here, the other level is going to be around 135.5. So with all the dollar pairs, we could see this kind of scenario that they don't give the market what it wants. People need to get out, but then, and the options have been really doing a good job over most of the past events, not all of them, but most of the past events, that we could go in here and then all of a sudden run into a layer of bids because those option players want to start to get their money back on what they paid premium wise. Okay, so keep this. I think this 137 and around 137.5 is going to be important to the downside. Okay, so this is how I look at cable. Aussie and Kiwi, reluctant to follow the last moves. We have seen a slowdown in the Aussie. We've seen a slowdown in the Kiwi, and we are around this 1618, just above that trend line. But the trend line is going to come lower, so I still think we are somewhere needing or wanting or waiting to make a decision on the Aussie, and that will be decided whether we are holding 6620 or holding 6720 or break. Okay, I think if we get above 6720 here, then we will be talking about 68s. If we start to get below 6620, people will be disappointed, and likely we are going to continue to trade a range. Again, it's really not my favorite scenario that they all go hawkish at the Fed, especially with Myron around. Even Cook around, she's not a hawk. So I would suspect that the market gets disappointed, and then we'll see what happens around 6620. 65.95 figure is your next level. I would really be surprised if this makes it back below 65.70 on this round of the Fed. Never say never, of course, but also I would be inclined to think, if we see a bit of a recovery in the dollar, people washing out their short dollars, and then perhaps start a move of recovery again. Last, and then I'm leaving it for today, we finally see some corrections in the metals. Gold has corrected, although China is still opening the doors to more imports in gold, etc. But we are correcting. We are back below the prior high in gold. Where can we go to? 3640, but I would especially look at this 3600 on the day. Longer term, don't change anything before we break below 35, 34.5. Okay, but on the day, watch if ever we get a less dovish Fed than hoped for or expected. If we get back down to 36, okay, all the non-monetary policy conditions for gold to remain bid are still in place, but it's come a fair way, so we can't exclude a bit more of a correction. I don't have anything running right now, but I will see what happens. Right around 36.5, then around 35.5, and then obviously around 35, the prior high here. But yeah, I mean, already look at what's happening here. The market is just correcting a bit. If we get above 37.35 though, I mean, then there's not much of before 38.80, and it's really we will be talking about 4K in the slipstream of all of this. Silver is doing one of those that it has done in the past. In this whole move higher in silver, we have seen these moves very often, okay, very often, and it's done one of these. All of a sudden the demand dries out just around this extension level and silver drops like a stone. Back below this upper trend line swiftly hasn't looked back, and we are already now testing below, which is the 78.6 of the very big 2011-2020 decline. We are already trading back below, but again, it's going to be important where we close today, whether we close above this 41.50-60 or not, okay? If we close below, if we confirm below this short-term trend line, which held since the start of September, we could go into the low 40s. Again, we have seen these moves in all the way up as well. Silver is doing this. It's a smaller market, a much smaller market than gold, okay? So we have seen these kind of moves. As I said, I've been quite fortunate to see it happen late last afternoon and in the night, and managed to let some more of my very, very long term go. So I'm not stressed, even if it would go down to 38.5. Long term, nothing has changed so far, unless we are starting to get closes below this 41.5, banging our head against, and then we need for the medium term to watch out if we would get a move below 40, back into 39.5 on silver, okay? But again, for the time being, we have seen this, okay? I would not start to call reversals yet, because all those things people have been calling them, and all those things we have seen them. If yes, reversals start at a point, right? But we can't call a reversal yet in silver. For me, that's far too early. And with that, Mr. Ryan, back over to you, mate.
Thank you very much, mate. All that's left is for me to wish you safe travels over the Fed later on. Don't do anything silly. Obviously, tomorrow we'll go over the super nuts and let you know what we think of it all. But until then, trade safe, and we'll see you tomorrow.